When a company is looking to raise capital for their business, usually they'll only consider debt or equity. But there is actually an instrument that sits in the middle called a convertible note. And today, I'm going to talk about what it is and when you may want to consider using it. In this video, I'll break down the basics of raising funding through convertible notes by discussing the differences between price rounds and convertible notes, the key pros and cons of convertible notes, as well as the terms you need to know when raising or investing in a convertible note. My name is Peter Harris, and over the last 15 years and over 100 investments in companies like Airbnb and Snap, I've had the pleasure of meeting with, evaluating, and investing in hundreds of founders in a variety of industries and stages. Today, I'm going to share some of the things I've learned about investing and raising money through that journey. But before we jump into this video, I want to hear from you what questions you have about financing startups. Pop down in the comments and let me know. And while you're there, don't forget to like this video and subscribe to my channel to get more great videos like this one. So let's imagine a scenario where there is an investor and an entrepreneur that want to work together. And let's imagine in this scenario that the company is relatively new and has little to no track record and little to no revenue. Because it's new, the company also has very few or no tangible assets and is unable to obtain debt financing from a traditional bank. But in order to build the company, the entrepreneur needs funds. Imagine in the future that this idea and company could be the next Google, or frankly, it could be like the tens of thousands of startups that fail every year. This uncertainty can make it very challenging to know how much a company should be worth. If you knew it was going to be the next Google with certainty, you'd be willing to pay a very high valuation for that. But the less sure you are, the lower the valuation would have to be for you to be willing to invest, because there's just so much risk that needs to be accounted for to justify the returns. Adding to this, you want to make sure that the founders own enough after investing that they are still excited about growing the business, since as an investor, you are dependent on them to build something amazing. These two factors combine to make it very challenging to use traditional methods like a discounted cash flow to put a value on a very early stage business. To help solve for this, investors will sometimes suggest the use of a convertible note. And in some cases, another instrument called a safe that is very similar. This is because a convertible note can lessen some of the pressure to find the right valuation today while providing meaningful upside for the investor and provides built-in downside protection if the company fails. So what is a convertible note? Well, in its simplest terms, it is a loan of capital, usually cash, that can be converted into equity, providing many of the downside protections of debt with the upside of equity. So let's talk about this in a real-world example. Imagine you and your co-founder are building the next big company in your garage. Your friend, a wealthy neighbor, is really interested in helping you with some capital, but it's too early to know how big it really could be, and you really need funds now in order to build the product and get it in the hands of customers. Rather than invest in equity or just give you a loan that she knows you probably won't be able to repay, she suggests investing via convertible note. It's like a flexible helper for your business's finances. Initially, it's like a loan from your friend, but with a twist. Later on, it can turn into ownership share of your company. It will allow you to defer the discussion on valuation until you have something a little more tangible to show for it. And it can be done quickly, cost-effectively, while also providing her with the first right to any remaining assets if things don't work out, thereby providing that downside protection. There are 6 key components to a convertible note. And those include, first, the principal amount. This is the cash that your friend invests initially as a loan to help start the company. The next is your interest rate. This is the amount that's paid while the investment is a loan. In the same way that you might pay rent when you borrow something like an apartment, the interest rate is the price being paid on borrowing capital from the investor. This is important because when the principal converts into equity at some future date, interest is no longer being paid on the principal. Instead, the principal has now been repaid in the form of equity rather than a repayment of cash, which is really what the investor wants. Great investors don't want to provide loans to startups. What they really want to do is invest, receive equity, and participate in the upside. In addition, since the goal is to provide the company with capital to grow, it wouldn't make sense to require the company to pay the interest in cash, right? We want every dollar that's available to go into the business, not to be paid back to investors in cash at this stage in the company. Instead, most convertible notes include what's called PIK interest, which stands for paid in kind. The idea being that the principal amount will simply increase by the amount of interest and hopefully convert into equity at some point in the future. Since the investment is not the main source of expected returns, it tends to be much lower than what a bank would charge, whereas a bank might charge 15, 20, or even 30% interest for that kind of risk. Most convertible notes I've seen over the last 15 years are in the 6 to 12% range. The third key part of a convertible note is the maturity date. This is the date when the loan will be due, usually requiring the company to pay back the investor the principal plus any accrued interest during that time period. However, this very rarely happens because if the maturity date arrives, it's usually because the company isn't doing very well. And if a company isn't doing very well, then they typically don't have the money to pay back the loan, let alone the interest. When this happens, typically investors will elect to extend the note to give the company more time to turn things around and hopefully find other investors who are willing to invest in equity, which may be a trigger to convert this convertible note into equity. If the company is successful in doing well, on the other hand, the notes will typically convert because the company will be doing well enough to attract additional investors, which oftentimes is a trigger for conversion. Conversion is usually decided by the note holders unless there are automatic conversion clauses, which we're going to talk about a little bit later. Number 4, the conversion discount. This clause is like giving the investor a special deal for supporting the company very early on. In fact, it gives them a better deal than others when their loan actually converts into equity. Usually this is just a discount to the valuation at time of conversion. So if a company raises capital from other investors, new investors, at a $10 million valuation, and the convertible note has a 20% discount, which is very common, then it would be as if the convertible note investor had invested at an $8 million valuation instead of the $10 million valuation. As a heads up, if you're reviewing the docs for a convertible note, you might notice that it doesn't say a 20% discount. Instead, it'll say something along the lines of, this investment will convert at 80% of the valuation of the next round, thereby indicating a 20% discount. Number 5 is the valuation cap, and it is another important term to understand in a convertible note. Sometimes a discount isn't quite enough to ensure that the investor is treated fairly. Think about it this way. The investor is a huge believer early on and gives you the money to build your company before anyone else, before you have a product or customers even. Then you build the product and growth explodes. Everybody wants your product and investors are clamoring to be able to invest, even at very high valuations. When the valuations are relatively low, like $10 million, a 20% discount can seem reasonable. But imagine that instead of $10 million, the company is now worth $100 million. And a 20% discount might not be enough. The goal of early stage investors is to make 10 to 100 times their investment. So converting at an $80 million valuation now means the company would have to someday be worth $800 million to $8 billion, which is really hard to do. To combat this, investors will often put a cap on the future valuation at which their loan will convert. For example, let's say I need a 20x return on my investments to be successful given the risk. I might require a $20 million cap on the valuation at conversion. This would mean that in order for me to achieve a 20x return, someday the company would need to be worth $400 million. That is a much more likely outcome than having no cap, watching the company raise at a $100 million valuation, converting at just a 20% discount, and resulting in an $80 million valuation at conversion. At that point, the company would have to be worth $1.6 billion instead of the $400 million, which is incredibly hard to do. So number 6 is probably one of the most important things to make sure you get right in a convertible note, and that is the conversion conditions. Now, this isn't just one term, this is a collection of different terms within the document that really spell out when the investment will convert from debt into equity. As a VC, you don't want to make loans to companies and only get paid interest. That's not why you're in the game. You're swinging for the fences. Returns from just the interest are not enough given the risk. Investors want equity and the theoretical unlimited upside that it offers. To achieve this, convertible notes will have different clauses that describe when the loan will convert into equity. The most typical will require that the company raise priced rounds, or in other words, a round of capital where they are selling equity at a mutually agreed price with investors. The terms will also usually reference a minimum amount that needs to be raised to ensure that the company isn't raising a little bit of money to force the conversion. Founders would love to convert the notes to equity in order to stop the accruing interest, But investors don't want to lose their downside protection at the wrong time or be forced to convert into inflated valuations. Having a large minimum can help avoid those issues. These rounds are called qualified financing events and are important to understand as part of your docs. So just to recap, why would you want to use a convertible note? Firstly, price rounds can be expensive in time and money. It's not uncommon for an average price round to span 3 to 12 months. If you're a startup, that time frame can kill your business. When things are streamlined, it usually takes 30 to 60 days just to get through confirmatory diligence and negotiate the final deal for an equity round, whereas a convertible note can close in as little as a day. And it's not just the timing that's expensive. The legal cost alone can be a huge financial burden on a new company. A convertible note can cost very little, in the hundreds to thousands in legal expense. There are great templates out there that entrepreneurs use all the time for it. A priced equity round typically costs in the tens of thousands of dollars, on the other hand. Another big reason why startups like convertible notes is that by giving out shares in a price round, you are also usually giving up at least a portion of the control and decision-making authority. For a lot of small companies, that isn't a good fit for what they are trying to accomplish, especially that early on. Convertible notes are great when there is ambiguity on what the valuation of the company should be. That being said, they aren't the best if there isn't that much ambiguity around the valuation. In that case, priced equity rounds are much better because investors get the equity that they want and founders know exactly how much equity they are giving up. And the investor-founder relationship is more clearly defined and less ambiguous. One word of caution, especially for investors. One challenge with convertible notes is that they can be raised without one firm taking a lead on setting the price and making the largest investment. When that doesn't happen and instead the company just receives lots of small checks from lots of small investors, it is sometimes called a party round. The problem is that if things don't happen to work out in the company, there's really nobody to hold the founders accountable and provide additional capital into the company. For more helpful videos like this, please like and subscribe and let me know in the comments if you have additional questions. If you'd like to learn more, be sure to check out my other video where I discuss the difference between a convertible note and a safe. And if you're really interested in becoming an expert in convertible notes, check out my mini course on convertible notes where I give an in-depth review of one of the most frequently used convertible notes out there and go point by point to help you understand each part. You can find a link for that down in the description below. Thanks.